Hey guys, today we're going to be talking about investing in equities in the stock market, the different investment strategies one can deploy in order to make a return, and a bit more about how you can allocate your portfolio across assets, something that's quite important in a higher interest rate environment where returns on bonds, for example, are a lot higher than they have been historically. So there are huge numbers of different listed companies out there. We know that the European stock market is quite a bit smaller than the US stock market, which is continuing to take up a greater and greater share of global stock market capitalisation, so the aggregate sum of all the market valuations of listed public companies. And there are numerous approaches you can use. Some of these approaches will work better depending on the market environment you're in. So what we saw after the huge COVID sell-off in March 2020 was huge significant appreciations in the prices of what was known as reopening and growth stocks. And that's sort of the one strategy you can deploy. It's known as growth investing. You look for companies that have high rates of revenue growth, what analysts call top-line growth. They're growing their sales on a year-on-year basis at a high rate. And they're doing that through taking market share with a new technology, or simply growing in a expanding market. So the common examples used are big tech companies. They are innovating, producing new products. For example, Apple, the iPhone came out, produced a whole new market for smartphones, displacing the existing market. And other examples can be obviously e-commerce companies like Amazon, which are growing because of the shift from retail to e-commerce. And so we're in a structurally high growth market, but also we're displacing existing players, of course. So yeah, that's one strategy you can use. Simply just look for top-line revenue growth, look for opportunities for companies to take share, disrupt markets, and also structural growth opportunities. In other words, markets which are inherently growing, like e-commerce, like AI. That's one strategy. And that does work quite well in a bull market. It worked well post, like I say, the COVID sell-off when interest rates were low. Analysts and indeed investors, the being the key people here, were a lot less focused on margins, how much money as a percentage you make from your sales, and profit, and the bottom line essentially they were less interested in, because essentially the way you value a company is through the discounted cash flow, where you take their future earnings, you assume what they're going to make in the future, and you discount it back using current interest rates to account for the time value of money, to account for the fact that if you invest money today, through interest it generates a return, and therefore money in the future has got to be higher to compensate for that, higher in relative absolute value terms. And in a lower interest rate environment, the discount rate you use to calculate the present value, is what they call today's value of cash flows in the future, was obviously a lot lower. And so people are a lot less concerned about the earnings of these companies and more focused on revenue growth. What's happened though is we've shifted from that environment to a significantly higher interest rate environment. Bank of England's base rate is 5%. The Federal Reserve raised the federal funds rate by a further 25 basis points yesterday. Most people think that's the peak, but we're at significantly higher rates than we were. And so in that environment, these growth stocks, which aren't producing much earnings, aren't as attractive. People are more interested in companies that are producing cash flows and are profitable. And typically what happens in a bear market, or a market which is seeing significant sell-offs like we've seen, more so in the second half of 2022 and early this year, was a shift towards what we call value investing, where you look for companies which you think are undervalued on particular valuation metrics relative to peers in their industry. So different metrics you can look at for valuations are things like price to earnings ratios, which basically takes the price of a share and divides it by the earnings that share generates. Others are things like enterprise value to EBITDA. Enterprise value is the total value of the company, the stock market value plus its debt, and EBITDA is the earnings before interest, tax, depreciation, and amortization. So essentially fake earnings before some other costs, essentially. You can also look at things like companies' dividend yield, etc., and look for companies which you think have similar growth profiles, similar market opportunities, but are priced at a discount. That's for a reason which you don't think is justified by the fundamentals. Maybe the fundamentals could be, okay, this company is trading at a 20% discount because the market thinks that its future growth is going to be lower, and that's because there's some competitive threats, or the market is concerned about the governance, the quality of the board of that company, and therefore it needs to trade at a discount. If there isn't, a rational reason that you can explain in the fundamentals of how that business operates and makes money to justify the discount, then that might be an attractive value investment. So that's another strategy you can use, value investing. Another one you can use is a very simple sort of passive index investing that's becoming more popular, where you just buy a created index like the Standard & Poor's 500, S&P 500 index, the FTSE 100 in the UK, the DAX in Germany, that simply tracks the biggest companies in that sector. It's diversified on principle, has lower fees because there's no active management cost like we are with mutual funds. And yeah, that's a diversified, low risk, passive, zero effort investment strategy, which actually beats the market in most instances. Beats mutual funds and people trying to beat the market in most instances. That's a great way to invest. Another option is to look for income stocks. Look for companies with high dividend yields, which you think will be able to pay those dividend yields, because at the end of the day, you need to look at what's known as basically dividend cover, like how much are their earnings relative to the dividends they're paying per share, and therefore how much cover have they got. So if their earnings dip 20% but they still have to pay the dividend, that's an important metric to look at. So companies which you think have got the dividend cover and offer an attractive dividend yield, and you just want to earn the income. In the UK, it's the stocks like Imperial Brands, British American Tobacco, Vodafone, sort of defensive utility names, AT&T in the US, etc. And you can get stocks with competitive advantages that pay decent dividends. Are very popular in the US, Johnson & Johnson, for example. It doesn't pay a 10% dividend like Vodafone, but I think it's around 5% from memory. And yeah, generates decent capital appreciation through share price. Say there are probably two other investing strategies you can deploy. One, I think these are probably a bit woollier than the others, less clearly defined, but one is quality investing, where you simply just look for high quality companies that you think have durable competitive advantages. The ones that come to mind, Amazon, Apple, etc. Those companies, they have high moats, high competitive advantages that make it difficult for new entrants to come into the market and disrupt. So that's another investing strategy. And then another one could be contrarian investing, where you think the market's being too negative or too positive on a particular name. For example, it could have been after the massive stock market boom in 2020, you could have looked at names like Zoom, which you think the market was being far too optimistic about, ignoring the competitive threats and extending 1 year's performance too far into the future. Or you could be looking at a company like what happened with Facebook recently when the stock went to, or Meta I should say, the stock went to $90 a share, and analysts were saying they're never going to generate any more levered free cash flow, and the costs have gone out of control, and their user growth has gone to zero. All of those things have proven to be false, so you could have made over 3x investment. So taking a view different to the market at a time where there's maximum fear or maximum optimism, contrarian investing works as well. And Buffett's strategy is sort of a combination of a lot of these. He looks for quality companies, ever more so now, once his assets under management got larger. When he was starting on in his career early on, he very much followed the Benjamin Graham value investing strategy, looking for companies which he thought were undervalued. But like I say, as his assets under management grew, he couldn't look for these, what basically called, at the time, small cigarettes on the street that you get one puff out of, companies that are ridiculously undervalued and they'll have to move back closer to their valuation, but they're terrible companies, they're not like high quality companies. And those companies tend to have smaller market caps, and so if you've got large amounts of assets under management, you need companies with bigger market caps to invest in, essentially larger companies. So he's had to transition towards this quality investing strategy. But he also does contrarian investing as well, of course. As part of buying undervalued stocks, you're often taking a contrary view to the market. So those are the main, like I say, investment strategies. What is Buffett's overall investment philosophy, and how does it fit into this? We've sort of described that a bit already. Like I say, he invests in high quality companies with durable competitive advantages that you think are likely to generate solid future earnings over quite a long period of time. That's his latest investment strategy. But he did start off buying bargain companies, and he's now more concerned about buying high quality companies at fair prices because of the growth in his asset under management. Buffett, and indeed all active investment managers, argue that the efficient market hypothesis, which basically states that the market takes into account all publicly available information, is therefore perfectly priced, is false. And this is clearly the case, otherwise people wouldn't beat the market if that was true. And his strategy is very much to buy when others are fearful and sell when others are greedy, because sentiment drives stock prices in the short term and fundamentals in the long run. And he has sort of 7 principles really, which is patience, because the stock market is essentially a machine that transfers wealth from wealthy and patient people to wealthy patient people. His second principle is quality first. His third principle is value. Fourth principle is diversification. Fifth is to avoid speculation. Sixth is to look at companies with strong management. And 7 is, like I say, buy when others are selling. That sentiment point. So what's my approach? How does it compare to Buffett's? How does it compare to these investment strategies, asset allocation strategies I've outlined? Well, I'm similar to Buffett in the sense that I look for undervalued securities that are under the radar, and I keep them on my watch list. So I'm trading 212, I have some stocks that I follow, and essentially I have price targets in mind, target prices where if that stock falls to a certain level, I will buy it. I do that by setting alerts, also by setting good to cancel buy orders. And when I see a large amount of selling in the markets, I'm taking that contrarian view for a company which I understand, which I think is actually quite a high quality company and has got a valuation higher than that share price. I will then buy that stock, and I tend to start off at quite a small amount. So for example, on say a 30k portfolio, I will buy maybe £500 worth, so about 1%, and if that stock then falls another 15-20%, I'll double my stake. And I tend to keep it there, unless it falls about another 50%, then I'll triple the stake, and that's sort of where I stop, because I'm buying sometimes companies which are being highly shorted. I'm taking an actively contrarian view, but I'm also very patient, so I'm holding stocks for 1 to 2 years. There were some Chinese education tech company stocks that I bought. People thought I was crazy. I was down 70% at the time and ended up making, well, I just sold a stake actually in one of them, and I made a 140% return over 18 months. That stock tripled. I didn't buy it at the right perfect bottom. That's the thing about investing for the long term. You can't necessarily get to the perfect bottom. For a stock that's fallen 95%, you shouldn't expect to. So yes, I look for undervalued, highly shorted companies, take a contrarian view, and I hold for the long term. And I don't bother about paying for insurance or anything like that, or buying equity indices. I'm enjoying trying to beat the market. And I don't speculate. I tend to try and keep a diversified portfolio, but like I say, if the right opportunity comes along, I will up my exposure. So I did buy a hell of a lot of Amazon at about $85 a share, which did happen to be right at the bottom. And I'm holding on to that, even though it is like about 25% of my portfolio. So that's my strategy. A warning though, if you are trying this yourself, most people fail to beat the market. Most professional fund managers fail to beat the market. So there's some stats here which basically shows the percentage of global equity managers underperforming the index, and this is as of the end of 2021, but it's actually worse, I'd imagine, if you look at more recent data. So over a 1-year time period, essentially this is for large cap stocks versus the S&P 500 index, 85% of fund managers underperform the S&P 500 over 1 year. Over 3 years that's 68%, 5 years 75%, 10 years 83%, and the big number here, 20 years 94%. We move to medium cap, to over 20 years it's 92%, small cap, again versus the S&P 500, 93%, and all US equity over the S&P 1500, 20-year time period, 92%. So in all instances, it's 92 to 94% of managers over a 20-year time period underperform the index. That's how difficult it is. And you can imagine that, therefore, if the professionals struggle, you're likely to struggle. So why am I taking this active role? Well, for me, it's actually working so far because I have a small amount of capital. I do think that for fund managers, they're investing huge amounts of capital, so finding these really undervalued stocks and being able to benefit from them is harder. But look, over a 20-year time period, I probably will underperform the index. That being said, at the moment, I think the S&P 500 is range bound. Is going to be range bound, for the next 4 years, and so I think my more active trading strategy might be more effective. But I'll probably be proved wrong. And if I had any advice to give to anyone, it would be buy an S&P index tracker. So I hope you enjoyed watching that video, and yeah, stay tuned for more stuff on equities and assets more generally. Have a great day.